everyone, welcome back to Corporate Decoder. Today we're diving into Enphase Energy's latest proxy statement. And let me tell you, it's juicier than you might think. Forget boring boardroom talk, this report is all about who's getting paid what and how they're trying to keep the ship afloat, which is why you should care about it. First off, this isn't just some document they file and forget. This proxy statement is essentially Enphase laying out all the big decisions for their upcoming shareholder meeting in May 2025. We're talking about electing directors, approving executive pay, increasing the stock available in their incentive plan, and even ratifying their accounting firm. It's a roadmap for the company's future, and it's important that you know what's going on. Enphase wants you to know they are all about customer first, quality, integrity, teamwork, and innovation. These sound nice, but what matters is if those words translate into revenue. Later in this video, we'll dissect some numbers to see if this is the case. The company is asking shareholders to pick two directors, Stephen Gomo and Thurman John Rogers, for a 3-year term. The company claims a classified board structure to promote boardroom continuity and institutional knowledge, as well as helping to drive execution of long-term strategy. But that begs the question, if all is well, why push so hard on existing directors? Now, Enphase engaged with their top stockholders, representing about 51% of their shares. They want feedback on corporate governance, pay, and their environmental impact. It's all about staying aligned with investor priorities. Now, let's get to the money. Executive compensation. Enphase is keen to show that pay is tied to performance. They tell us that 67% of their stock awards for executives are based on performance. Also, they want you to know they did not increase the base salary of their CEO, which is always good PR. Let's get to voting. They are recommending that you vote for the 2 directors and 3 proposals, including the say on pay, executive compensation, and another amendment to increase the number of shares of common stock authorized for issuance. But what does that mean, and are they worth voting for? We have a couple of key directors in question. Stephen J. Gomo, who is the chair of the board, brings financial and business expertise with years of CFO experience. Then there's Thurman John Rogers, who founded Cypress Semiconductor and has 35 years of CEO experience. These are not exactly youngsters bringing into question fresh perspectives. Now, about the board's independence. The board says that each of Messrs. Gomo, Courtline, Malkow, Mora, and Rogers and Mishengi is independent. Basically, they don't have relationships that would mess with their ability to make unbiased judgments. Risk oversight is a big deal, and the board is handling it through various committees. The audit committee looks at financial and accounting risks, plus cybersecurity and compliance. The nominating committee handles governance and sustainability, and the compensation committee keeps an eye on compensation-related risks. Now let's check out that director compensation. Stephen J. Gomo, as board chair, made about $75,000. Other directors pulled in around $300,000 to $35,000. Keep in mind that these are the folks steering the ship. Time for the juicy details. In 2024, the top 3 executives were Badrinarayan and Kothandraman, the CEO, Mandy Yang, the CFO, and David Randhoff. Former Chief Commercial Officer, Randhoff actually transitioned out of his executive role mid-year to a part-time role. Enphase uses Asvina goals, which are specific, measurable, achievable, relevant, and time-based. Here's a quick look into those high-level individual goals. CFO Mandy Yang was tasked with growing revenue, improving margins, and digitizing channel management. The former CCO David Randhoff was also focused on revenue growth, but also overseeing improvements to inventory management. Now let's break down the cash bonus. For 2024, CEO Kothandaramanan earned roughly 5% of his possible target annual bonus. CFO Yang made roughly 6% of her target. The bonus is dependent on certain corporate metrics with specific scoring. Enphase has 59 goals, including stretch goals. They were awarded PSU's Performance Stock Unit Awards based on the level of achievement of the annual CEO SMART goals at 50% of target. It looks like things were set high, but not impossible. Digging into those goals, we see targets for revenue, profit, new products, innovation, operations, quality, and even ESG, environmental, social, and governance targets. There are goals for how the company does, plus stretch goals. Overall, it seems they had high expectations but fell a bit short, hence the 50% payout on the goals-based PSUs. But that doesn't mean it's all bad. Looking at the potential equity payouts, the CEO had a target of 33,000 shares, based on the CEO's SMART goals and 34,000. For hitting relative TSR, this represents a large reward, so it may have been very difficult to obtain. As in 2024, the number of shares paid out for 2024 performance resulted in 16,500 for the CEO and 8,580 for the other two mentioned officers. Clawback policies are in place, meaning if someone messes up the financials, they might have to give back some of their compensation, which helps create some accountability. Enphase has an insider trading policy and they prohibit hedging or pledging of company stock. Here is the important part where we summarize compensation. In 2024, the CEO made $12.6 million for the CFO and $6.6 million for the former CCO. Finally, BlackRock and the Vanguard Group are the big shareholders, each holding around 12% of the stock. These institutional investors have a major say in what happens at Enphase. Now my take. Enphase is dealing with a tough market right now. While they pushed forward on important projects like new meters and next-gen inverters, it seems they also had high revenue targets. But sales numbers didn't quite meet them, with that being the largest point drop. The company ended up with a CEO having a compensation reduction based on performance, and the company is pushing for continued efforts. One thing that sticks out is the tension between innovation and financial performance. The company had innovative goals, yet sales were down and debt are up. There are also the risks around supply chain and changing energy policies. These are things to monitor. Enphase needs to prove it can be adaptable and grow market share. If not, the stock will suffer. That being said, the company seems on the right track to push through the next few years. I expect positive returns in the long term based on current pricing. Thanks for watching. If you found this breakdown helpful, give us a like, drop a comment, and definitely subscribe for more corporate deep dives.